Of course, this is not financial advice and for entertainment purposes only. You're earning over $100,000 a year in income and dividends. The real question is, when are you going to retire? Is it going to be soon?
But I definitely don't think these are scam products. I don't think this is a pyramid scheme. I don't think the whole thing's going to fall apart. For the passive income, right? If you want to retire sooner than later, then that would be the reason to buy covered call ETFs, to get the passive income, to replace your job and be able to retire at a younger age.
Investors, welcome a very, very special guest, Mr. Paul Santori from Blossom. He's like super popular, I guess, a celebrity on this app called Blossom, which is a free investing app where you can see both of our portfolios. So if you guys want to see Paul's portfolio or my portfolio, you guys could check out the link in the description of this video or in the pinned comment section. But Paul, your bio on Blossom says that you're almost 52 years old and still working, but my passive income far exceeds my work income, hoping to share my journey and help others. You have about 42 holdings, mostly, if not, I believe all in ETFs, besides a couple stocks, from YieldMax ETFs, Rec Shares, Roundhill, Defiance, Harvest, Tap Alpha, Hamilton, Global X, even SCHD by Charles Schwab. You have a 30% yield, which is quite impressive. I'd say that's super healthy. Your portfolio is valued at over $400,000. Super impressive, with your average monthly income that you told me was about $8,200 in distributions and dividends from your portfolio. Once again, super impressive, $2,000 a week in income. And also congrats on hitting over $100,000 per year verified by Blossom in your portfolio. I said a lot, Paul. First question is, how are you feeling about being on the channel and being a guest on my channel?
Hey, Marcos, thank you for that incredible introduction. I'm really honored and excited to be on your channel. Thank you so much for the invitation. I'm really looking forward to this conversation. As you know, and people in Blossom know, I love posting about my portfolio, posting about investing and ETFs. And truthfully, I'm just trying to help people, like to inspire people to see, what is possible, especially if you're like myself, getting a little bit older, a little bit closer to retirement, but maybe you're struggling with your savings. You don't have $1 million or a $2 million portfolio. You're looking at the 4% rule. So 4% of my $400,000 portfolio is not enough to live on. So I had to look for other ways of producing enough income to eventually retire. And unfortunately, I have no pension. So this is basically it. Like, this is all or nothing for me. So I don't know if it's a big gamble or a risk, but I think the last 3 years have proven that it's working, and it's working really well.
And give us a brief overview of how you got started with investing and what got you here today with an over $400,000 portfolio.
Yeah, sure. So I live in Canada. I went to Sheridan College. I studied business. So I've always kind of been interested in making money in that. When I was younger, somebody gave me the book, The Wealthy Barber. I'm not sure if that's popular in the States or not, but it's a fantastic book. It's very, very easy to read. And it explains a lot about, investing and insurance and just things you should do, to be successful as you get older. So I started out with mutual funds, because when I was younger, that was basically what everybody did. It was the easiest thing to invest in, right? We didn't have Robinhood and Wealthsimple and all these online brokers like we do today, where I can just go on my phone and for no cost at all, I can buy 1 share, I can buy 10 shares, it doesn't matter. I actually found a statement back in, I think it was early 2000, I bought some stocks from a bank in Canada, it was $29. That was the fee, was $29 to make that purchase, which nowadays nobody would pay that anymore, right? Anyways, fast forward to 2020, when the stock market crashed, and I decided that I was no longer going to invest in mutual funds. I was going to sell everything I had, move it over to RBC, to a brokerage account, and start buying stocks. So I started that process of selling my mutual funds, transferring the money over, started watching a lot of YouTube videos, and I found Wealthsimple, which is kind of like our Canadian version of Robinhood. So I opened up an account with Wealthsimple, I started buying your traditional stocks, right? Your blue chip bank stocks, oil companies, ones that pay quarterly dividends. What, 2024, I guess? YieldMax came out with their suite of ETFs. Other companies in Canada started coming out with more covered call ETFs. So I started one by one selling off all of my stocks that were maybe paying, individual stocks paying a 4% dividend or a 5% dividend, and I would upgrade them to an ETF that was paying 8%. Then better ETFs came out paying higher dividends. And I just kept doing that. I call it organic growth. Without actually putting money into my portfolio, I was increasing the yields and the distributions, right? And then reinvesting everything. And I went from about 150,000 in 2020 to now having just over $400,000.
What was like that switch from, I guess, like traditional dividend growers, like individual stocks? Maybe you might have had some blue chips that were maybe growth stocks to high income cover call investing. It's like a super, it's not the newest world, but now it's like the trending thing. And, you have a super healthy yield, in my opinion, for a cover call portfolio. 30%, that's not like teetering on, super, super high risk.
I think for myself personally, I was really motivated by the monthly income and growing that income, and the sort of like the long-term traditional game of buying, say like a Johnson and Johnson where it's a 2% yield, but then a 10% increase every year. But you have to hold it for 20, 30 years before you really start making money from it. Well, at my age, I didn't want to have to try and wait another 20 years to retire. And I guess I don't have the patience to wait for those quarterly dividends, and I find it I mean it's exciting. Nowadays with the weeklies, you get a dividend every Friday, right? So like today's dividend day, I'm just waiting for my notifications on my phone, and like Ari said, it's a dopamine rush, right? It really is, and you start seeing those dividends roll in. And I think today I'm probably going to make about $1,000 Canadian, which probably more than I'll make this week at work. So, it's very exciting. And I was writing down some numbers just before I sat down with you to talk. And 2023, my total distributions for the year was about $35,000. Last year, it jumped to $65,000. That's a $30,000 increase, right? I don't get that kind of raise at work. I'm lucky if I get a raise at work. So this way, I'm giving myself raises all the time. So far this year, I've already made 57,000. By next month, I will have exceeded all of last year, and there's still 4 months to go, right? The dividend growth investing is too slow for me.
You have SCHD, which is a dividend growth ETF. I know it doesn't screen for growth, it just happens to have like dividend growth. Investing in SCHD because that was the big thing last year and the year before that and the year before that. And now it's more of high income cover call ETFs.
You know what? I still have SCHD. I still really like it. I would actually like to start buying some SCHG as well. I think the growth version. The way I look at it is I have so many high yield ETFs in my US RRSP, right? So I've got your ULTY and your YMAX and YMAG and, all those. So I kind of thought maybe if I take the distributions from those ETFs, put it into SCHD, maybe it will give me a little bit of an emergency fund or a safety net but to be honest with you, I haven't been buying too much of it lately because I'm addicted to that, the new TSPY. I love TSPY. It's paying, I think, 14%, which is a great yield, right? It's not too high and it's not too low. It's kind of a real sweet spot. But also, I can never buy it on the dip because it just keeps going up. You know what I mean? Like every day I look at it, I'm waiting for it to fall below my average cost. And then every day it's up another 10, 20, 30 cents. So I buy weekly. I'll buy more today. And unfortunately, I'm averaging up. But I like it so much, I really would like to bring it up to one of my top positions.
Can you give me a rundown of your investing portfolio? I know you have a lot of positions. Just a general rundown of like how you go about choosing ETFs. Why is your top fund being Harvest and then YieldMax and whatnot? I know you have like a lot of ETF issuers, but give me a brief rundown on your portfolio.
Sure. So last year, right about this time, I started going heavy into YieldMax. YieldMax was really like the funds themselves were really hot last year. They were doing really well. That's when MSTY was paying its, like $4 a month distributions. YMAX was over $20 a share. The distributions were high. So between, I think, July and December, my monthly income like went from about four, maybe $5,000 a month to, I think in December I hit 8,800 was my best month ever. And it was all yield maxed. But then what happened was in, I think it was January, there was a bit of a dip in the market, right? And a lot of the yield max ETFs dropped a lot. Like take a look at CONY. CONY used to be, I think, over $20 a share, and now it's sitting around $9 a share. So instead of paying $2 a month, now it's paying, 70 cents or 80 cents. But luckily for us Canadians, Harvest came out with their kind of like own version of Yield Max, except we don't use the synthetic shares. Harvest doesn't have synthetic shares, and they don't write on 100% of the portfolio. So it's a little bit more conservative, right? The yields are not as low, but the share price seems to be a little bit more stable, and in a lot of cases is actually appreciating. But I started switching a lot of my other funds into the new Harvest funds like HHIS, MSTE, which is basically like MSTY, but with 25% leverage. We have a CONY version. We have a Palantir one that's doing great. And yeah, those kind of where my portfolio monthly income started to dip a bit because of yield max dropping a little. These Harvest ones have completely taken over and helped me, increase my monthly. So I have those, but then of course I like to diversify across fund providers. I don't want to have all my money in Harvest just in case something goes wrong with Harvest. So as you said, I have Hamilton, I have my HYLD, which is a fund of funds. So that's around 12 or 13% yield, but I think that adds some stability as well, right? Like we talked about Tap Alpha with TSPY, that's another one, adds a little bit of stability. There's another CEO. I don't know if you've ever watched any of his interviews, but there's a company in Toronto called Evolve. And if you get a chance to watch interviews, the CEO is brilliant, brilliant and well spoken. So he has some ETFs. One of them is called Bank. So I buy that one to get exposure to the Canadian banks because finances is one of our largest sectors in Canada. And then there's another one called UTS, which is your utilities. So I have that. From Global X, I have ENCL, which covers your gas and oil. So really, Marcos, what I'm trying to do is pick different fund providers, and within those fund providers to try to pick different sectors, or different specialties. Maybe one of them is the S&P 500, one of them is the NASDAQ, and then specific sectors, and then right down to single stock ETFs. And, once you put all together 35 different positions, even if one is down a little bit for a month or two, their distributions, other ones are up. And over the long run, it seems to be smoothing out. I think I'm excited for today because I think this is possibly going to be my best month ever. There's 5 weeks, there's 5 Fridays in August. So I think I'm going to break 10,000 in August.
I was just about to say maybe you're going to hit over 10.
Yeah.
The risk tolerance of your portfolio and your strategy. People would say, okay, high income is lower risk than growth investing, but I know some of your ETFs have some leverage on it to increase the volatility, increase the growth. At your age and your time in your life, what kind of risk tolerance do you have right now in your portfolio? And what will your risk tolerance be long term? And how will you position your portfolio to get to that risk tolerance that you have maybe in the future?
Well, I'm pretty much 100% invested in equities. I think I have one fund from Harvest that holds bonds, but it's a very small position. I don't really foresee myself buying anything like GICs in Canada. We have the guaranteed investment certificates that might pay 3 or 4%. I don't think I'm going to go that route. To be honest with you, Marcos, I have a very high tolerance for risk now because I've been investing long enough that I've seen how people overreact to the market, right? When something bad happens, I don't know who these people are that are selling off all their investments, but for the rest of us, it's an opportunity to buy. Maybe I'm overweighted in technology right now, but at the same time, I feel like technology is the future, right? I mean, are these big companies going anywhere? I don't think they are, right? So, and when you have the S&P 500, you got your exposure to the 500 companies and it itself regulates, right? It'll take out the ones that are not doing well and put in the ones that are doing better. I think I will maintain this risk tolerance for a long time, to be honest with you.
We have traditional cover call ETFs, right? I guess you could say TSPY is a traditional cover call ETF on
Yeah.
an index, right? Like the S&P, like the NASDAQ, and then they either do zero DTEs or just a traditional 30-day cover call strategy.
Yep.
Now we have the higher income payers on single stocks on cover calls, YieldMax, you said Harvest as well. So you've been investing for quite a while now. Maybe when you first saw YieldMax, what was your thoughts of it? Were you skeptical? What made you pull the trigger on YieldMax? Because people, when they see these 80 to 100% yields, now the yields are dropping, they would say it's a scam. But you pulled the trigger, and so have thousands of investors on Blossom have pulled the trigger on YieldMax. So I want to hear all about it.
Yeah, when YieldMax first came out, if I recall, I was pretty skeptical and hesitant, and I thought, I'll just watch this for a while. And I know a lot of people jumped into TSLY, because that was TSLY and OARC were the first two. A lot of people jumped in on it, and I was kind of sitting on the sidelines and seeing people making all this money. And so eventually, I think it was around $18 a share. I decided, okay, I'm going to buy some TSLY. And of course, TSLY, as we all know, dropped a lot. And the thing is, it's not a scam, right? People say it's a scam or it's NAV erosion or price erosion or, whatever you want to call it. The fund is doing what it's supposed to do. The problem is the underlying holding, right? If Tesla, the stock, drops significantly, well, then the ETF is going to do the same, right? Because that's what it's following. So you have to realize the risk of the stock that you're holding. And if you don't believe in a stock like Tesla or Palantir, Nvidia, right, then don't invest in them, right? The other thing is, I wouldn't put all my money. Like I wouldn't say, okay, I'm going to take all $400,000 and put it into MSTY and just retire tomorrow, because you can't have all your eggs in one basket. So I think you have to understand how a particular fund works, what the risks of that fund are, and how to mitigate those risks. Right now, I'm buying more YMAX, because I was buying it above $20 a share. Now it's around $14 a share. So I'm averaging down, right? I'm bringing my average cost down, and it's kind of smoothed out a bit. That's what I'm doing anyways. I'm trying to add to certain positions to bring my cost down, take advantage of the distributions they're paying at the time. And also what I'll do is, maybe I have 4 or 5 YieldMax funds, and I'll take all the distributions from them and I'll buy TSPY. So that way it doesn't cost me anything to buy TSPY. I'm not taking money from my pocket to buy it, but I'm building up a position. I think I just hit 200 shares of TSPY, but I'm buying it all with YieldMax dividends. That's the way I kind of balance out the risk. But I definitely don't think these are scam products. I don't think this is a pyramid scheme. I don't think the whole thing's going to fall apart. Take a look at QYLD. I think it's been out for more than 10 years now.
Why do you have diversified ETFs as like your core? I know that's like a weird question, but I've seen people go, all in on MSTY or all in on TSLY, but you have kind of like those diversified picks. So why TSPY? Why HHIS? Is it just more of like a comfort level of you could sleep better at night holding these diversified ETFs?
Yeah, I mean, it sounds kind of strange having a portfolio that pays 30% and to say at the same time, I'm kind of risk averse. But, if you sit down and do the math and say, hey, if I just took all the money I have currently and put it in ULTY, my weekly dividend might be $5,000 a week. At the same time, if ULTY, crashes down to a dollar or two a share, I could lose everything. So yeah, I mean, I like the diversified ETFs or the fund of funds like HHIS. See, with HHIS, you're getting exposure to all 15 of Harvest's single stock tickers, right? So instead of having to buy them individually, this way I have them all. And if one's doing well and one's not doing well, it balances itself out. And it aims to pay a 25% distribution. How can you go wrong with that? Right?
Yeah.
25%. Even if you live on half the distribution, that's 12.5%. Reinvest the other 12.5%. So in theory, my portfolio should keep growing. My monthly income should keep growing. I think it's a win-win, right?
Tell me more about TSPY. I know that's been gaining popularity. It's been gaining like 1 million in AUM every day for the past like couple of weeks. It's not the sexiest yield, right? It's 14%. It's not 25. It's not 30, 40, 50. If you're looking at total returns, it's been doing phenomenally.
Yeah. You know what? I started out probably a year or two ago with, I think, JEPI, right? Started out with JEPI, maybe it was 8 or 9% yield. And then I thought, you know what, I'm going to sell all my JEPI and put it in JEPQ, right? Because JEPQ was paying a little higher. Then I sold JEPQ and I went into, I think, SPY, you know, because it was paying more. And then I went to SPY T. I don't know if you've heard of SPY T, but SPY T was aiming to do 20% because a lot of the defined products like QQQY, they tanked, right? And people got really upset with the share price tanking. So Defiance decided to come out with SPY T and QQQT and have a 20% dividend yield goal. So I bought those ones as well, right? I sold. So I keep moving up, right? Now, those ones did drop a bit in share price and haven't recovered as quickly. So eventually TSPY came out and I watched the interviews and I just really like the CEO. You know, he's not even a financial guy. I think he's a computer engineer, right? But he's very intelligent and he seems to be able to figure out how to use his computer skills, you know, mix it with what he knew about the S&P 500 and writing options and calls and puts, put them together and create this product that's just doing phenomenally. As much as I like having the higher yielders, to have something that is consistent, you know, something you can depend on, something that's reliable. It's kind of like the SCHD of covered call ETFs, right?
Your top YieldMax ETF is YMAX, and then you have TSLY, ULTY, YMAG, CONY, MSTY, NVIDIA, AMZ, FBY, etc. Why is your top holding from YieldMax YMAX? I'm assuming it's because of the fund of funds diversified route.
Yeah. Well, when I first started buying YMAX, I actually put it into two different portfolios, and I think I had 250 shares in each. And then, like I told you, the share price dropped so much, I kind of started adding to it again, and I put a goal of having 1,000 shares, 500 in each. So I've been working on that. Once I reach that, I think I'll stop buying it. Currently, I'm also buying Alti weekly. I mean, Alti, I unfortunately bought it before it tanked. So I think I bought it when it was up around 19 or $20 a share. And, you know, I lost, say, 60%, but only on paper, right? I haven't lost anything because I didn't sell. But now that it's down around 630 or 640 a share, I am buying Alti weekly as well. With the YieldMax funds, when they went to groups, you know, group A, B, C, and D, I just wanted to make sure I had something from each group, right? So I kind of picked the most popular at the time. I already had TSLY. I think I already had CONY, you know, added NVDA. And the last group, I guess, is MSTY. So I wanted to have one or two from each group. Now, I know they keep launching more, and I think I've missed out on some good ones. I think the Palantir one was really good. Now they have the one from Robinhood. It's done really well. So I have missed out on a couple of the good ones, but it's hard to buy everything. You know, you can't have everything, but it is nice to have at least something from each group to pay on a Friday.
You're earning over $100,000 a year in income and dividends. The real question is, when are you going to retire? Is it going to be soon?
So I just took a look at stock events. I don't know if you guys use that in the States, but stock events is a platform where you can put in all your information. I put in all the stocks that I have or ETFs that I have. You put in how many you own and what your share price, your average cost is, and it calculates the dividends for you. So I took a look this morning, and because this is a particularly good week for YieldMax, it says I'm going to make 129,000. Now that's over the next 12 months. And that's assuming that those YieldMax and, you know, YMAG payments are consistent, which we all know they're not going to be, right? Next week, YMAX could drop back down to 10 cents and that number will change. But I think that's the highest it's ever been so far. In terms of retiring, I still have a mortgage. You know, I still have two kids, one in university, one in college. So still trying to help them, you know, pay for stuff like that. My wife said I'm too young to retire, so I don't think I'm allowed. I would like to build up more of a cushion, to be honest with you. I've started putting a little bit of money. Wealthsimple came out with a bank account. So I started funneling a little bit of my dividends into a bank account so I can have a bit of a cushion before I, you know, give notice at work and pull the plug on that. So I'm kind of doing a few things to prepare for it, but I'm not quite there yet.
Number for dividends per year? Is it a portfolio value like 3 million, 2 million for retirement?
The portfolio value is not as important to me, but I would really be happy to see it over 500,000. I don't think it's ever going to get to a million or $2 million, but I think I'd like to see it over 500,000. And I think I would like to see my monthly dividends somewhere between maybe 15 and 20,000 would be nice. You know, there's periods right now things are really good. The market's good. But there are going to be periods where the market's down. You know what I mean? And there's a good chance that a lot of these ETFs could cut their distributions. You know, so if I'm making 15,000 a month and they cut the distributions, maybe it drops down to 10, I'm still okay. Right? I don't want to retire at making 8 or 9,000 a month and it drops down to 4 and then all of a sudden I'm panicking and I'm in trouble.
Talking about like dividend cuts or income cuts, we've seen YieldMax do that. It's not their fault. It's just the way volatility works and then the underlying works. When you're about to retire, are you going to go more into like some bond allocations, SCHD more, TSPY more, safer index-based cover call ETFs, or are you going to try to keep your portfolio the way it is right now?
No, I'm just going to keep it the way it is right now. I'm going to keep building up my TSPY position. I'm really hoping they're going to come out with their NASDAQ version. I think that's going to be launched once they hit 50 million in assets under management. So once they do that, we'll see where my TSPY is at, and then I'll start building that position instead. I might add to some of my positions that are a little bit more on the safer side, some of the fund of funds as opposed to the single stock ETFs. Really, I like to do a bit of both. Like this week, I bought ENCL, which is an oil and gas fund, but at the same time, I'm buying YMAX and ULTY. So it's a nice thing about getting passive income when you're making, $8,000 or $9,000 a month. You have a lot of money to invest in the market, so you can put a little here, put a little bit there, and balance things out.
So
No,
no bonds,
no, no bonds.
no treasuries, nothing.
No,
Okay.
no.
People always tell me like, Marcos, you need to get a higher yield. My top holding is the S&P
Yeah.
VOO. This ties into like this next question is you have a 30% yield. Maybe 5 years ago people can't comprehend how you get a yield like that. The question is, do you believe that high income investing with your 30% yield will be sustainable long term?
Well, I've seen people like yourself, in interviewing CEOs from YieldMax and other companies, and this question usually gets passed on to them. And it sounds as if this is just a growing market, right? Like the stock market itself is not reducing in size. It's just getting bigger and bigger and bigger. And I've heard some predictions of how large they think it's going to be, and that this is all sustainable. So I'm hoping that it'll just keep going.
Bear markets are inevitable. In the case of a recession, we might see, or we will see, distributions go down, income payments go down from these cover call ETFs, just the way it works. Share prices will drop. How will you react in a recession with your portfolio? And do you even have like fears of a recession? Will you just be buying more of your favorite ETFs?
Yeah, I think that's the plan, right? Is as things go down in price, just buy more, right? And even if the distribution goes down a bit at the time, you're picking up the shares at a cheaper price. And eventually, when the economy recovers, you're just going to be in a better position, right? You're going to be in a better spot. I will say I watch a couple of Canadian YouTubers, one of them being the Dividend guy. I don't know if you've ever heard of Mike Carew from Montreal, but he talks about something that he calls a cash wedge. So he's a dividend growth investor, and he explains how, in bear markets where your portfolio drops and you don't want to sell shares, you have to have what he calls a cash wedge. So what I'm trying to figure out is, as an income investor, how do I create this cash wedge? So if the market drops, I don't have to worry about if some of my, ETFs drop their distribution as well. So maybe that means having some cash on the side or some money in a high interest savings account. I'm not 100% sure yet. It's something that I'm kind of working on, trying to take his model for a dividend growth investor and create the same thing for an income investor. Because we all know there's going to be a bear market eventually, right? We all know the market's going to crash eventually. So basically, we just have to prepare for it.
You earn over $100,000 in income, maybe 130 this year, 129, like you said, in income. So are taxes a big concern for you? And if not, why? Or if yes, why?
Yeah. Well, I don't fully understand the American tax advantage accounts, right? But in Canada, we have a few. The number one tax advantage account that we have that they created about 20 years ago is called a tax-free savings account. And a lot of people get confused by that because it's not a savings account. It's really an investment account. So you put in money after you pay your taxes. So whatever you get paid at work, you've already paid tax. You put money into there after tax. Anything you pull out of it is tax free. So right now, I think I'm making about $4,500 or $5,000 a month in my TFSA. If I take that money out, there's no tax implication, right? The government doesn't know that you've taken the money out. Most of my other portfolio is in a registered retirement savings plan. So whatever you make in your RSP is irrelevant to taxes. When you take money out, you have to pay taxes at whatever income tax level you're at. So whether I have funds in there that make 2% in dividends or make 100% in dividends, that doesn't matter. What matters is how much I pull out in a year. So I haven't figured that out yet because I am still working, but I'm sure there's an optimal number. If I take out $15,000 or $20,000 a year from my RSP, the tax will be, like nearly nothing.
When you envision yourself retiring, what will that look like, and what will you be spending your income and dividends on?
Hopefully traveling. Even though I'm not retired yet, we've already started traveling more. So we try right now to go on 3 or 4 vacations a year. And hopefully once we're retired, probably in our 60s, it'll be vacationing hopefully most of the time.
You have FEPI and AIPI, but I know those are super good ETFs if you want cover calls from Rec shares. What made you pull the trigger on FEPI and AIPI?
Yeah, so I bought those, I think about a year ago, maybe a little bit more than a year ago when they came out and they were first really popular. If I recall, FEPI at the time was paying 25%, was kind of like the yield, and AIPI was paying 35%. So I bought, I think, 110 shares of each. I just wanted to have like an even balance of the two. And the problem was when the market did pull back, right, they dropped in share price, which people will call NAV erosion, but I think it's more of a share erosion, right? So now, instead of being, I think they were both around $53 or $54 a share, now they're in the middle 40s. Rec shares is still paying you the same 25% and 35% yield, but they're paying that yield on the new share price, right? So I'm not getting, my yield on cost is now lower than what it was when I bought them, right? Because of the share. And I thought about, should I sell them? Should I keep them? I wasn't 100% sure what to do. But the dividends came in yesterday and it's kind of a nice boost at the end of the month, right? Because Harvest, Hamilton, Evolve, they all pay in the first 10 days of the month, right? So my distributions are kind of like front loaded. So this is kind of a nice like end of the month bonus. So for right now, I think I'm going to keep them. I did post about it on Blossom. I asked some people about what they're doing, and somebody recommended MAG. It pays on a Monday, which is also fun, kind of wake up in the beginning of the week and get another dividend. And I think the yield's higher than I thought it was. I thought it was a low yield, but I was told it's around 30%. So if that's the case, I might start funneling some of my distributions into MAG.
If someone asked you, what would be one reason as to why they should do high income investing?
For the passive income, right? If you want to retire sooner than later, then that would be the reason to buy covered call ETFs, to get the passive income, to replace your job and be able to retire at a younger age. I know everybody knows that these ETFs are going to underperform the underlying stocks. That's a different type of investing. If you want to be a single stock investor, or a growth investor, I mean, those are great avenues as well. But yeah, that would be it. Just to retire sooner than later.
Just own the underlying. For example, CONY, just own Coinbase. Everybody has different goals, risk tolerances. We could argue that, a cover call ETF of a index or a single stock is going to be like less risky than the underlying asset. So do you ever get comments on people just saying, Paul, just own the underlying?
Oh yeah, all the time people make comments about covered call ETFs and how they're not going to work. And I'll be honest, on Blossom, it seems like lately more and more people are just positive and friendly. And, I don't get as many of the negative comments as I used to. But, and I think that's because these ETFs seem to be proving themselves over time. As far as owning the actual stocks themselves, you really have to know what you're doing, right? You get guys like, Warren Buffett and Charlie Munger who make it look easy, you know what I mean? But they have teams of people and they have information and knowledge that we don't have. And if you don't understand what you're doing, you could buy the wrong stocks or you can buy them at the wrong time so instead of worrying about all of that, I find this is a much simpler for the average person to do. And in my opinion, it's way better than what a lot of people were doing was getting a financial advisor who's going to tell you to buy mutual funds that, the company they work for is promoting. And at the end of the day, it seems like they're making all the money and we're not.
How do you invest in ETFs? Do you dollar cost average, lump sum, combination of both?
Yeah, I do a little bit of everything, to be honest with you. If I have a good size amount of money and I have a particular ETF that I want to buy, I might go and buy five or $10,000 at once. Although that has proven to bite me because you buy something and then it drops, right? Maybe the market takes a turn for the worse and it drops down in value, and then you wish you hadn't have bought so much at once. So I guess buying a little bit at a time is also not a bad way to go. I've also had the opposite happen. I bought PLTE from Harvest when it launched. The day it launched, I bought it at 12.90. I saw this morning it's at $25 a share. So it almost doubled in price. So I really wish I had bought more on that first day.
Reinvesting the dividends or income. I know you said that some of your positions, like for example, by YieldMax, you would take the distributions, reinvest it into TSPY or other ETFs, right? How do you go about dripping your income that you receive from all your ETFs? Do you mostly reinvest it back into that ETF that paid you the dividend or the income, or do you just take the income, and reinvest it into other higher conviction plays?
So if I have an ETF like TSPY where I want to continue adding to the position, right, and buying more shares, then the dividends that come from TSPY are going to go back into TSPY. Once I hit the point where I don't want any more, right, like I'm trying to get TSPY right now to about 500 shares. I'm only at 200. HHIS, I want to get to 5,000 shares. I'm at 4,700, right? Once I hit those numbers that I want to be at, then I'll take the money from those ETFs and I'll start funneling it into something else.
What's one mistake you made early on in your investing journey that you think people should always avoid?
Oh, geez, I made a lot of mistakes. One mistake that I made more than once is to try and buy small cap stocks. I think it was back in 2022. There was a lot of financial YouTubers who were talking about a number of small cap stocks, and I thought, oh, you know what, that sounds good. I'll put $500 in this one and $500 in that one, and a lot of them, they're not even around anymore. Or if they're around, they're worth pennies on the dollar. So I lost not a lot of money, but percentage wise, some of them went to zero. So I lost 100%. So that was a big mistake for me anyways. I would stay away from small cap stocks if you really don't know what you're doing. The single stocks that I bought them after COVID, at a great price, but I didn't have the patience to hold on to them long enough, right? So I bought Canadian Natural Resources at $19 a share. I sold it just under $30 a share, thinking I had made, a good profit, but I didn't realize that the potential of that stock, it went over $100 a share. So just not having the patience to hold on to it long enough and selling too early, yeah, it cost me a lot of money.
I know, I think I saw in Blossom you're helping your son, I believe, build a portfolio. Is that correct?
Yes, yeah, for sure.
So, what advice would you give to somebody maybe starting out to build a high income ETF portfolio?
Yeah. So if you're, in Canada, 18 years old, I would recommend open up your tax-free savings account and start, depositing money. What I tell my kids to do is, if they get a paycheck, at least 10%, take at least 10% of whatever you made, put it in there and, pick one or two covered call ETFs and start buying them until you have, say, 100 shares. But at the same time, what I have my son doing now, if you look at his portfolio, is he's investing in XEQT. So he's going to be a hybrid investor. He's young. He doesn't need to be, an income investor. He likes the excitement of it, right? Every month when he sees the dividends coming in, it kind of, it's an easy way for him to see that he's making money. And also, he's got a goal now where he gets to $200 a month in dividends. And then that $200 a month will buy him XEQT while he's at school. He doesn't have to work anymore. He doesn't have to deposit money, but he'll still be buying XEQT every month.
Is high income investing underrated or overrated?
I think it's underrated.
Why?
Well, I think the majority of people are still skeptical about it. Still, don't think it's going to work in the long run. Probably still leaning more towards growth investing or other types of investing.
Now, have you ever thought about using margin or leverage or maybe taking out loans to invest in your portfolio? I know so many people are doing that. So I want to
Yeah.
ask you because you have kids and a family and you can't be losing your shirt on, using leverage in your portfolio.
You know what? I mean, I see people talk about it on YouTube or Blossom, and I've watched some videos about guys who use margin, and I'm sure you've seen the Oracle. Oracle's always talking about how much money he's making, buying 10,000 shares of ULTY and doing it all on margin. But honestly, Marcos, I'm not a gambler. You know what I mean? If I get together with friends to play poker, if it's a $20 game, I'm in. You know what I mean? But I'm not going to go to the casino and drop like $500 in a night and lose that money. For me, buying stuff like ULTY, that's kind of like as risky as I want to get. Simple has sent me notifications that I can margin something like $45,000, but I don't. No, I'm not going to do it. I'm not going to do it.
Now, when somebody watches this video, maybe what's one thing you want them to take away from this video, hearing your story or just advice that you want to give them?
I think, well, first of all, I checked yesterday and I hit 7,000 followers on Blossom. It actually blows my mind. I mean, I make posts on Blossom. I do them more or less just to inspire people, but I don't sit down. I've read some posts on Blossom. They're amazing. They're almost too long. Like I'm reading this and it's like so much information. And I get to the point where I can't even finish. But anyways, but they're great posts. And I try to keep mine a little bit shorter and simple, just an update of something that's happened or a milestone that I hit or, a fund that's doing really well. But what I'd like people to know is that anybody can do this, right? I'm not a financial expert. I didn't go to a fancy school and study how to analyze stocks and, invest. I just, spend a little bit of time each day. I watch a couple of videos a day. A lot of times I'll listen to them while I'm driving in the car, try to educate myself, keep up on what's new and, what's working and what's not working. And just, you know, start small. You know what I mean? The first time I bought a split corp in Canada, DFN, I bought 10 shares, right? I waited a month. It paid me the dividend. I was like, okay, I like this. This works, So I bought 10 more, right? I didn't go in on the first day and invest lots of money. But I think anybody can do it. I think it's simple enough that really anybody can do it.
I guess as an investor, there's going to be a time where this is all going to end for us, right? In terms of maybe we're not watching YouTube videos, we're not keeping up on the next big ETF or the next big idea. We're going to be hopefully on the beach, kind of like off the grid, maybe with our kids when they grow up and have kids and have a family, and you can spend time with your wife or your husband. So when this is all said and done, are you gonna, I guess, pass down your portfolio to your kids? Are you trying to leave them with some, a good chunk of change or?
Yeah, it's funny you talk about going on vacations and being on the beach. And honestly, one of the things I love doing the most is being somewhere in the world with my phone and buying stocks. Like wake up on a Wednesday morning, you're on a beach, in Aruba or somewhere, and just pull out your phone and go on Simple, and you see what dividends you got, and like, okay, let me buy some more stocks. Now I'm going to make some more money, and and then off back on your vacation mode, right? In terms of my kids, like I really am hoping that I can get to a point where, my monthly income is enough that I can help them out more. Maybe I can help them, with paying for cars or paying more for their schooling, maybe help them buy a house someday. Yeah, that would be fantastic, right? I would love to leave them an inheritance. That's the plan. What I'm really hoping is that as opposed to the 4% rule, where I think your portfolio of $2 million is supposed to last until you're 90, and then basically you've used it all. I'm kind of hoping that my portfolio will just keep growing and generating income, and then they can take it over and do the same.
Last question for you is what are some tips or advice that you would give to somebody who wants to have a 400 plus $1,000 portfolio and maybe even make over 6,000, or should I say $100,000 in dividends per year one day?
You know what? One thing I don't think we've talked about, Marcos, but consistency is the key, right? You have to keep investing, right? This is not just once a year or something. Every paycheck, I mean, if you're starting out at 18 or 19 or whatever age you are and investing in the market, set up a pay yourself first plan, right? Have money come out of your account on your payday, go right into your brokerage account. Consider it like a phone bill or, your car payment, whatever, and just start investing. But it's consistency over time, right? I didn't get to where I'm at now, in 1 year or 6 months, right? It's been 5 years now that I've been working on this. And 2 years ago, maybe I was making $2,000 a month, and the thought of retiring wasn't even really in the picture. So, but consistency is key. You got to keep working at it. You got to keep doing it. If you get a bonus at work, invest it. If you get a raise at work, increase your investments, increase your contributions.
Final words before we close out this episode.
I guess the only thing, Marcos, I'd like to say is to plug my own channel that I started last Friday. So today's the 8th day. So my channel is called Better Call Paul. I did a poll on Blossom, and somebody was kind enough to make that suggestion, and we decided we liked it, so we went for it. Of course, as I was creating the YouTube channel, I realized there's like 40 other Better Call Pauls. So, but it's been fun so far. I know Candace from Mountain Finance said your first 100 videos are going to be no good. So I kind of keeping the bar low for now and just hoping that we keep getting better as it goes along.
And investors, thank you so much for watching this episode. Don't forget to go subscribe to Paul's newest and latest YouTube channel, Better Call Paul. We'll have some B-roll on exactly where you could find them. Don't forget to give us a follow on Blossom. Thank you guys so much for watching this video. If you guys like this video, please give it a like because this cute puppy did. And don't forget to check out our last episodes right here as well, or right here. I love you guys so much. Crushing the stock market, and take it easy.
Thanks, Marcos.
Peace.
Bye.